Here's a visual representation of the income statement, which the income statement is good for a period in time, generally referring to maybe a quarter. At the very top of the income statement is your overall revenues, sometimes referred to as sales. Now what we do here is we have to take that first step down, that first cost. That first cost is usually a direct cost. So I'm going to write the word direct cost here. And this direct cost usually is referred to as the cost of goods sold or the cost of goods manufacturing, depending on if we're dealing with a service-oriented company or a manufacturing-oriented company. And then what we do is we have this first profit margin here. And this first profit margin is referred to as your gross profit margin. So if you were selling maybe widgets that we were selling for $1 a piece and it cost 50 cents to make, our gross profit would be 50 cents on the dollar. And it's going to be depending on the industry. Some industries have high direct costs, some have low direct costs. The next cost that we have here is an indirect cost. So I'll put the word indirect here. Indirect cost, usually. Indirect cost. Indirect costs are things like your sales and general and administrative costs, sometimes referred to as SG&A. So now I'm going to go ahead and look at this next profit margin. This next profit margin is sometimes referred to as your operating margin. I'm just going to put operating profit here. Then we have to take our next expense. Our next expense is an interesting expense because it technically is not an expense. So I'm going to draw the line here, and then I'm going to call this the depreciation. Now, depreciation isn't actually an expense. Now, depreciation can also be called amortization and depletion, depending on if we're depreciating out a tangible good. Intangibles are usually amortized out. And then, of course, depletion refers to like natural resources. I'm going to put an exclamation point here and here because they are not an actual cash payment. However, what they do is they lower our overall revenue or sales so we pay less in taxes. That's a whole different story in how we depreciate out. So we'll leave it there for right now. And I'm going to go back to my income statement here and take this one here. Now I'm going to write here that this is sometimes referred to as the earnings before we pay interest and taxes. Kind of hard to see that with this E a little bit better. And basically that's saying the earnings before I have to pay my interest and my taxes, leaving here with my net income. Now I'm going to go ahead and write the word so we don't forget that. This will be our interest expense, and this will be my taxes I have to pay. So in essence, what an income statement really is revenues minus expenses, giving me my overall profit or amount of profits, or as referred to a minute ago as net income. Now what a company chooses to do with this net income, generally what we're going to do is we're going to retain it. We'll put the word retain, and we have a statement for retain earnings. So I'm going to retain these earnings for future purchases. And in summary, that is an income statement.